In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how India's economy looked just before all this global trade chaos began and why this particular snapshot matters right now more than it ever did. And in the second story of the day, I'll talk about India's growing e-rickshaw industry and how it is driving our EV revolution, but it is also dangerously at the edge of rules. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 25th of April. See, a few months ago, there was a lot of curiosity about where India's economy was exactly standing. Now, December's GDP numbers were not out yet, but it sort of felt like we needed a mental map of sorts. So therefore, our team decided to look at dozens of economic charts and data sets in order to get a sense of how things were going for us. And what came out of that was not really a simple answer. It was a messy, nuanced picture. India's economy seemed to be holding steady, but not exactly booming as such. But it was not even struggling either. It almost felt like while we were moving forward, we were not moving forward fast, but we were definitely moving with resilience. But at that time, what we definitely did not see coming was a sharp U-turn in global economic sentiments. Since then, the biggest news in the world of trade has been America's decision to impose tariffs, which is obviously, as you all may know it, higher taxes on goods that are coming into their country. Now, mind you, these are not regular tariffs. They are historically in scale and they are expected to disrupt global trade in a very, very serious way. And when the world's biggest economy makes imports more expensive, it just does not affect the exporting countries. It sort of shakes up the entire global trading system. And therefore, this move has brought in a new level of uncertainty altogether. There is a fear that if things start to escalate from here, the US could enter into a recession, which is a phase where its economy starts to shrink instead of starting to grow. And if that happens, the ripple effects could be massive. Countries that rely on global trade in order to grow, especially those that export a lot of goods like say Vietnam or Bangladesh, could be hit really hard. And while India is not very deeply integrated into global trade as these particular countries, we aren't totally immune to it either. So therefore, a global slowdown is definitely bound to affect us in some or the other way. And that is why today it's a good time to revisit that data that we had spoken about back in December. And this is not to predict what will happen because the full impact of these new tariffs has not shown up in the numbers yet, and it will be very long for all of us to sit down here and make any assumptions either. And the most recent data that we have right now is from the month of March, which is before this chaos sort of even began. But the good part is that it does give us a very good snapshot of where the Indian economy stood just before the ground beneath us sort of began to shift apart. You can almost think of it like the before picture, which is the benchmark that we can come back to as we see how things evolve in the coming few months. So therefore, let's start by looking at how the economy was even performing back then. See, back in February, things looked sluggish. One reason was simply that February had one less day this year because last year was a leap year with an extra day in the month of February. Now I know this may sound a little stupid to some of you because what will one extra day even do? But I'll remind you that one day in 29 or 30 days is actually about 3%, so that does make a big difference. So anyway, that makes year-on-year comparisons a little bit tricky and makes this year's February data look slightly weaker than it might have actually been. But even beyond that technicality, the month seemed genuinely quiet. Several economic indicators pointed out to a slowdown. Consumption had softened and investments had slowed down as well. The services sector was one of the only few areas that actually held up decently well. Industrial production for February, which tracks how much output came from various sectors, rose by just 2.9%. Now, of course, that's not really bad, but it is almost very modest to be honest. Most high-frequency indicators, which is the kind of data points that come in weekly or even monthly, did not show much cheer either. But then came March and the mood suddenly started to shift a little bit. The auto sector, which had struggled in the month of February, bounced back in the month of March. Car sales went up again, which is usually a sign that people feel okay about their future. Basically, buying a vehicle is a big financial decision, so when people do it, it suggests some level of optimism in the atmosphere. Fuel consumption rose as well, although diesel, which is the primary fuel used in trucks, tractors and commercial vehicles, stayed mostly flat. And that could mean that while people were out and about a little more, the heavy heavy-duty movement of goods did not really go up quite a bit. But still, the movement of goods and people was up overall. E-way bill generation and toll collections, both of which are strong indicators of road transport activity, saw double-digit growth as well. And this usually means that businesses were active, goods were moving, and logistics were ticking along as well. Power generation also rose quite a bit, which can be a good sign of increased activity across multiple industries. Though it is worth remembering that March was unusually hot this year, so some of that electricity could just be going into running air conditioners, not necessarily only factories. One more positive sign was in tax collections. See, the government collects GST on most goods and services that are sold in the country, so when GST collections go up, it generally means that there is a healthy business activity in our country. In both February and March months, GST collections grew by about 10% year over year, which is quite decent to say the least. But anyway, looking deeper into the structure of the economy, India's core sectors, which are heavy industries like steel, coal, cement, and fertilizers, which feed into the rest of the economy, grew by 3.8% in the month of March. Now, that is a reasonable number. Cement production, especially, was up over 10%, which hints at active construction and infrastructure work in the country. So, all in all, the Indian economy in the month of March was not really on fire, so to speak, but it was not slowing down either. It was more or less running at a stable, steady pace. Now, the big question is, how did regular people like you and I and the others feel about this? See, interestingly, there was a fair bit of optimism in the atmosphere. According to the RBI's consumer confidence surveys, people expected their consumption to rise in the coming year, and these expectations were stronger than they had been in years. Sentiment was improving as well, and many people were also feeling positive about India's overall economic condition. In rural areas, this mood was even more prominent. More than half the rural respondents say that they felt confident about their job prospects and their income levels as well. And that is important because rural sentiments usually drive consumptions in large parts of our country. Inflation, which had been a huge headache for Indian households in the recent years, had also come under control. In March, for example, inflation was at 3.3%, which is the lowest in nearly 6 years. And a big reason for that was that food prices had calmed down. Fuel prices, on the other hand, were still high, but at least they were not shooting up even further. With inflation easing, people's expectation for future inflation also started to come down, which may have sort of helped lift consumer sentiment to some degree. But still, not everything was smooth. India's unemployment rate remained stuck at around 8%. Now, mind you, that has been the case for many years, and it sort of reflects deep structural issues in our labor market. Even formal sector job growth, which had been a bright spot earlier, slowed down sharply in the last quarter. So while people may have felt a little bit okay about their lives in general, the job market really had not become any healthier. Now let's move on and talk about trade. See, India is not really popular for being a massive exporter, to be honest. For many years, this was seen as a weakness of ours, which is a sign that we were not globally competitive as other countries like China or say even Vietnam. But in a world that is now retreating from free trade, that same weakness has started to look like a kind of protection for us. We simply have less to lose. Our exports to the US, for instance, make up just 2.1% of our GDP, which is a very small number in comparison to the other players. But still, we are not completely disconnected from the rest of the world. And even before America's new tariffs officially came in, we could see signs of anticipation. Exports to the US rose sharply in the month of March, likely because American businesses were rushing to buy goods before the tariffs made them expensive. Indian ports also saw more activity during this period, which sort of seems to support this theory as well. Now, this last-minute buying in the US stood sort of in contrast to our overall exports, which were down for most part of the quarter. Exports fell in January, dropped sharply in February as well, and then barely recovered in the month of March. Globally as well, trade was fairly weak, so India was not alone in this entire slump. In fact, compared to how badly some other countries were doing, India actually looked relatively much better. And meanwhile, India's imports rose by 11% year on year in the month of March. A lot of that came from gold, petroleum, and electronics. And gold prices have been climbing largely because people look for safe havens in these uncertain times, and India, being one of the biggest consumers of gold, naturally imported more of it. Electronics imports also went up, possibly because Chinese products that would have gone to the US otherwise are now being redirected to other markets like India. And because exports were weak and imports stayed high, India's trade deficit, which is by the way the gap between what we sell and what we buy, remained fairly large. And that affects how foreign money flows into our country. See, while the foreign direct investment or FDI numbers looked healthy until the month of February, with a 15.2% increase year over year, most of that money also left the country eventually. The net inflow was just $1.5 billion US. Portfolio investors who buy Indian stocks and bonds were also fairly cautious. They pulled money out of Indian equities companies, but they kept investing in debt, possibly seeing it as safer. But despite all of this, Indian businesses, especially into manufacturing and services, still seem more confident than their peers abroad. And that may also be why institutions like the IMF and the RBI continue to see India as one of the few major economies that are expected to grow above 6% this year. The RBI in particular has started to ease up its stance. After months of holding back, it has now taken a more supportive approach and has promised enough liquidity to help the economy along. Credit growth remains strong, which means banks are still lending and businesses are still borrowing. And that is a great sign of economic activity. But that said, government spending has been a little bit of a letdown. Capital expenditure from the central government, which basically funds long-term investments like roads and railways, has not grown too much compared to last year. States have been spending less as well, especially on things like infrastructure. But all said and done, there is definitely hope from private investors. In the March quarter, investment announcements from private companies started to shoot up. And if those actually translate into projects, they could give a very big push to economic growth down the line. And agriculture, by the way, was doing quite well as well. Sowing for the summer crop was up significantly. Tractor sales in February jumped by nearly 36%, and fertilizer sales were also fairly strong. Now, for your context, a good harvest can help inflation keep low and can also put more money into the hands of people in the rural areas, which then, of course, feeds back into the wider economy. So all in all, if I were to summarize, the Indian economy as of March was in a stable but a fragile state. Like I said, we were not really in trouble as such, but we were not doing greatly either. The data suggests that we were managing to hold things together of sorts, even as the rest of the world was looking much more shaky. But now, with global trade tensions rising quite fast and the US heading towards more protectionist policies, the environment is changing quite quickly. The question that we will probably all be looking forward to is how India does in this entire new trade world. On that note, let's move on to the second story of the day and talk about e-rickshaws. See, let's say you live in a big city and you do not own a car or a bike. How do you get around? For most people, I know the answer will be public transport. But the thing is, in India, public transport is not just metros and buses. There is one more kind of vehicle that is pretty much everywhere, and the one that quietly powers the life of millions of people, which is the three-wheeler. I'm referring to the e-rickshaws and e-autos, which are small three-wheeler electric vehicles that have sort of taken over as the go-to option for short trips in India. They are cheap, they are convenient, and they are sort of everywhere right now. And as surprising as it may sound, this vehicle category is currently leading the EV race in India. It's not electric cars, it's not electric bikes, but it is actually electric three-wheelers. According to the International Energy Agency, three-wheelers are actually the most electrified road transport segment in the entire world. In 2023, for example, around 21% of all three-wheelers sold globally were electric. And that number was just 18% the year before, so the shift is happening very quickly. And mind you, it is not China or the US that is driving it. It is India. India became the world's largest market for electric three-wheelers in 2023, which is a huge deal. But here is where things get a little bit tricky. See, while electric three-wheelers sounds like a big green victory for us, the story on the ground is far more complicated. There is definitely a lot that is going right, but also a little bit that is also going wrong. But before we get into the details, let's first get a very clear understanding of what an e-rickshaw means and how it is exactly different from an e-auto. The e-rickshaws are the lighter, slower cousins of the traditional auto rickshaw. You can think of them as battery-powered versions of cycle rickshaws of sorts. They usually run at speeds under 25 km per hour, and they are mostly powered by old-school lead-acid batteries. And that makes them cheap, simple, and often handmade or assembled from imported kits. But e-autos, on the other hand, are a little bit more like the auto rickshaws that we are all used to. They are sturdier, they are faster, and they are typically made by bigger manufacturers like, say, Mahindra or Piaggio. In cities like Delhi, electric three-wheelers now make up a huge share of the EV market. But here is the thing, 93% of those are e-rickshaws. E-autos are just a small 7%. And that actually tells us that the action is really happening at the cheaper, lower tech end of the entire spectrum. And it's that part of the industry where most of the problems also lie. So to get into the details, let's start by understanding how these vehicles are even allowed to run on our roads. See, back in 2010, just before the Commonwealth Games, e-rickshaws started coming up in Delhi. They were basically supposed to help traditional cycle rickshaw drivers make the switch to motorized transport. But they were not officially recognized as vehicles back then. They didn't have number plates, they didn't have a license, and they did not even have to follow traffic rules. They basically existed in a legal grey area of sorts. It only was in 2015 that the government formally classified e-rickshaws as motor vehicles. And that meant that they now had to follow all rules like getting registered with the transport office, having number plates, and so on and so forth. But here is where a key policy decision sort of changed everything. While most commercial vehicles like autos and taxis need a permit to operate, and these permits are usually capped by the way, the government decided that e-rickshaws would not need any such permits. Basically, once you register your e-rickshaw, you can start carrying passengers, you do not require a separate license, and there is obviously no cap. The idea was to make it easy for poor drivers to enter the transport system and to earn a good livelihood. And in that sense, it definitely worked out. Delhi streets were soon filled with e-rickshaws, but it also created a lot of chaos. With absolutely no cap on the number of e-rickshaws, the market sort of exploded, and this was far beyond what city infrastructure could really handle. And there's another catch here. The same low entry barriers that made it easy to own an e-rickshaw also made it easy to bypass the rules. You were supposed to register your vehicle, get a fitness certificate, and buy insurance, but many owners did not even bother about it. In Delhi, nearly half of all e-rickshaws are estimated to be unregistered, mind you. And that means no official identity, no roadworthiness checks, and no insurance, and absolutely nothing else as well. Just electric motor, a few wheels, and a driver trying to earn a living. Now, a big reason for that is that most drivers come from low-income, semi-literate backgrounds. And of course, navigating government paperwork is not really easy for them. On top of that, there is now a whole parallel industry that makes it very easy to buy and run e-rickshaws without ever going through official channels altogether. And that exact thing brings me to the next issue, which is how these vehicles are even made in the first place. See, unlike auto rickshaws, which are made by large companies with strict standards, most e-rickshaws are actually assembled by small local businesses. These small players usually import cheap kits from China with everything from the motor to the frame to the battery included, and they sort of only put them together in local workshops. Some of them don't even bother with brand names, they just sell it as a vehicle, no questions asked. Now the thing is, for a vehicle to be registered legally in India, it needs to pass certain safety tests by agencies like ARAI or ICAT, and many of these kit-based e-rickshaws have not gone through that process at all. And this means they are technically illegal. But they're still everywhere, right? And since they are not registered, they also do not go through any safety or maintenance checks, so if the brakes fail or the battery catches fire, there is absolutely nobody to hold accountable. Now, to be fair, things are definitely getting better. Companies like Mahindra, Kinetic Green, and Saira Mayuri have entered the e-rickshaw space with proper manufacturing, quality standards, and regulatory approvals as well. Government schemes like the FAME 2 and the newer PM E-Drive have also nudged the market towards more formalization, where they're offering subsidies only to vehicles with higher quality lithium-ion batteries. So definitely, the top end of the e-rickshaw market is getting cleaner over time. But the problem still remains with the bottom end, which is running the show, to be honest, because that is what poor buyers can really afford. And for them, it's not just about the vehicle, it is also about keeping it charged. And that brings me to the third and perhaps the most worrying issue, which is batteries and charging. See, most e-rickshaws in India run on lead acid batteries. Now, these are the same kinds of battery that you would find in older cars or inverters. They are basically cheap at around 30,000 rupees for a full set, but they are also heavy, inefficient, and very short-lived. After about 8 to 12 months, they stop working and they need to be replaced. And this creates a massive waste problem. Most of these used batteries end up in informal recycling sector, where untrained workers extract the lead and acid without any safety gear whatsoever. It is basically dangerous, toxic, and completely unregulated. Lithium-ion batteries, which are the kinds that are used in electric cars and scooters, are much better in that regard. They last longer, they charge faster, and they are much safer. But the problem is that they are expensive. A lithium-ion battery pack can cost 2 or 3 times more than the lead-acid one. And for most drivers, that is just not affordable or does not make any amount of business sense. And then there is also the issue of charging. See, the government has basically spent a lot of money building public EV charging stations, but they are designated for cars and bikes and not really e-rickshaws. And that is because they use high voltage connections which are specifically meant for lithium-ion batteries, and lead-acid batteries just cannot use them. So the question then becomes, where do e-rickshaw drivers even charge their vehicles? Now, many people do it at home and they use a regular wall socket, but not everyone has that option really. In slums and informal settlements, power connections are patchy, very illegal and sometimes even unreachable. So people get creative. Some people tap into street lights, others set up small roadside charging stations, which are basically sheds with extension cords, and many of these setups sort of steal power by bypassing electricity meters. It is a huge problem. In Delhi alone, Discoms estimate that 120 crore worth rupees of electricity is lost every single year due to e-rickshaw related power theft. It also overloads transformers and increases the risk of fires. So that, ladies and gentlemen, is the current state of the e-rickshaw industry in India. It is definitely a system that is doing a lot of good work because it is giving work to thousands of poorer drivers, it is offering cheap transport to millions of people, and it is pushing India ahead in our EV goals. But the problem is that it's also running on weak foundations. It is under-regulated, it is sort of unsafe, and in many ways almost illegal. The problem is that if the government tries to clamp down too hard, where they crack down on illegal vehicles, unregistered drivers, and unsafe chargers, it could sort of destroy the livelihoods of people who rely on this system. But if we also let things run the way they are, the problems will only obviously get worse over time. Unregistered vehicles will continue to flood the roads, battery waste will keep piling up, and the whole ecosystem will sort of remain stuck in a grey zone which is too big to ignore but too messy to fix. That brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, the landed price of palm oil in India has dropped sharply by nearly 7 to 8% following global disruptions caused by the US tariff hike earlier this month. Crude soybean oil prices also fell by $48 per ton between April 11th and April 21st, nearly erasing the earlier price premium over palm oil. Second, Tata Consumer Products Limited reported a 59% year-over-year increase in consolidated net profit for Q4 of FY 2025. They reached 345 crore rupees, driven by exceptional gains. But that said, consolidated EBITDA declined 1%, with EBITDA margins slipping by 110 basis points to 14.2%, primarily due to elevated tea input costs. Third and the final one for the day, India's steel industry has recorded a steep 330% rise in trade deficit in FY 2025, reaching $4.75 billion compared to $1.09 billion in FY 2024, according to Steel Ministry data accessed by Business Line. In rupee terms, the gap widened to 40,152 crore rupees from 9,035 crore rupees, which is nearly a 345% increase. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.